Okay.
A review of 2024 to 2025.
Reader's Digest highlights, please.
Will you turn the mic on? There you go.
Absolutely.
Okay.
All right. Should we dive in?
Yes.
All right, excellent. So we've got today in front of you all the January 1st, 2025 actuarial valuation report for the City of Olivet Salaried Employees Retirement Plan. Overall, I think what the report is going to show you is that the investment return outperformed expectations. The investment return was a 9.75% investment return compared to a 7% expected return. So that's going to be fueling funded status improvement. There were a few items that kind of pulled the funded status back, primarily our review of the annual demographic changes. When we collected census information, we noted that there was a higher than expected compensation growth fueled by recent inflation. And so the liabilities had a liability loss generated from the higher than expected compensation increases. So that took a little bit out of the funded status improvement. One thing to note is we're going to show multiple versions of funded status throughout this report. There's a funded status measure that's dictated that we report to JPERS, and they use an interest rate that's a blend between our long-term investment return assumption of 7% and short-term corporate bond rates, which are closer to 5%. And so that blend resulted in an interest rate of 6.28% this year, which was an increase from the blended rate last year of 6.06%. As long as that funded status continues to improve, we'll work again towards getting back to using a 7% return assumption for both our long-term asset expectations and discounting those liabilities. But as long as that funded status kind of stays below 80% or so, we're going to have to continue to use that blending approach.
So are the benefits that retirees receive is tied into inflation? Is that what you're saying?
The benefits that active participants are earning are tied to their compensation.
Right.
And so the compensation increases over the last 2 years kind of reflect the high level of inflation that we've seen over the last
nothing to do
couple
with
of years.
Payout. It's the
Correct.
people that are in the plan.
The people in the plan.
Okay.
So overall, we're going to see funded status improvement from a variety of sources. Again, at a high level, the funded status of the plan is kind of in a similar range than it's been in over the last 10 years. We've seen that this plan is heavily reliant on investment return. As investment performance outperforms the expectation, we see funded status improvement. And then when we see a correction in the market, we end up kind of reverting back down. And so when we look at some of the historical trends, you'll see that we're in a similar place that we were about 10 years ago in terms of the funded status. Just from all of the swings in investment returns. Moving to page 4, we'll go through the slides quickly to get to the main points. This is our asset development. January 1st, 2024, we started the year at 21.98 million, and throughout the year we ended at 23 million. We can see that there was 1.2 million of contributions, both from individuals and from the city tax collections. Benefit distributions totaled 2.26 million and administrative expenses were 14,000. The investment return, again, noting that the investment return of 9.75 favorable investment return year had a 2.090 investment return, fueling that investment growth to the 23.0 million ending asset value. Moving to slide 5, this is our review of our recommended contribution analysis. And we've got 2025 on the left compared to 2024 on the right. We look at, when we look at the contribution recommendation, there's 2 components of that recommended contribution. There's the normal cost. That is the value that your active participants are accruing for 1 year of service and compensation growth within the plan. So that's the cost of providing 1 year of benefit growth to your active participants. And then the amortization component is funding up the unfunded liability that currently exists for the pension plan. And we show it over 3 different time periods, a 10-year, a 20-year, and a 30-year amortization period. The normal cost component for 1/1/2025 was 605,513. And then when we look at the 20-year amortization schedule, which is the recommended contribution schedule for the plan, the amortization component was 808,525. So that leaves a total beginning of year recommended contribution of 1.4 million. When we apply interest to the end of the year to reflect timing of those tax contributions being made, that grows that to 1.5 million. And when we reduce the employee contribution expected portion of that, the remaining 1.266 is the recommended tax revenue or employer contribution that we would recommend. We can see that's similar in level to the 2024 amount. And so there are two things going on. We saw funded status improvements, which reduced the amortization component because your unfunded liability improved. But that was offset by growth in the normal cost for your participants. And that was from two components. One, slightly more active participants during 2025 than 2024. And that compensation growth that we talked about grew the expected annual cost for the active participants. So we saw a substantial growth in that normal cost from 500 to 600,000, which offset the deterioration of that amortization component. So we'd expect that amortization component to kind of draw down over time as you pay the unfunded liability off. But it was offset by that normal cost, leaving a flat recommended contribution.
Why is there a $300,000 decrease of estimated tax revenue?
Yeah, so there was timing difference in 2024. I think there was a $300,000 timing difference that the contributions that were reflected for 2024 just happened later, and so we reflected a $300,000 additional contribution for the 2024 plan year than 2025.
Oh, okay. It's all good.
So which is the normal amount? Is 700,000?
700,000 is normal. That would be what we would see from property tax revenue.
Okay.
Right? Would you agree with that? Yeah.
And that's an estimate, obviously.
Correct.
Okay. Yeah.
Nice and rounded.
Yeah, that's what I was gonna say. Okay.
Maybe a question for Darren. Have you seen much of a difference with the senior tax freeze in terms of like? Okay. Okay. Cool.
Moving to page 6, this will be the first funded status measure that we will note today. And here we've got the present value of vested accrued benefits and the present value of accrued benefits. So if we go to the bottom line, we see an improvement year over year on the present value of accrued benefits from 79% to 82%. Again, this is using a 6.28% interest rate for purposes of valuing those liabilities. The liabilities are 28 million compared to the assets of 23 million, leaving a $5 million shortfall on this present value of accrued benefits basis. What the present value of accrued benefits basis is measuring is your liabilities only considering pay and service through 1/1/2025. So we're not doing any projections forward. This is the benefits that have been earned to date through 1/1/2025 on a present value basis. So we saw, again, improvement there driven mostly by that outperformance in the investment return compared to the 7%.
Jennifer, and that's when we talked with the attorneys and they said that principal was 100% funded. That's why I was very confused when they said that. Not to get into it right now, but that was why it was very confusing when they did say that, because we're underfunded. So.
We'll see if the attorneys really know what they were talking
Yeah,
about.
exactly.
On page 7, this is the demographic review of participant counts. We can see that the active participant count increased from 53 to 58 participants from 1/1/24 to 1/1/2025. The retiree headcount increased from 73 to 77. And then the terminated vested participants increased from 31 to 33 participants. Page 8. We're going to look at a second view of funded status, and this does what I call more actuarial gymnastics. So we are no longer just looking at compensation and service through 1/1/2025. We're now going to project out through a participant's career what we expect their liabilities to be, and then discount back and create an accrued liability as of 1/1/2025. But what we're doing is, because your pay kind of grows in a almost an exponential shape towards the end of your career, you grow more of your pension benefit in the last 5 years of service than you do earlier in your career. So we're going to pull some of the cost associated with those years earlier into a participant's career and make a more level funding approach. So the liabilities here a little bit higher because we're trying to reflect a little bit more level funded approach over a participant's career, and not letting it backload like it does on the present value of accrued benefits basis. So you'll see here that the accrued liability at the bottom is 32.166 million compared to the present value of accrued benefits, which is 28.0 million. So that $4 million difference is really associated with that actuarial gymnastics and accounting for those costs earlier in a participant's career, and not just waiting until the most expensive time to start funding those benefits. This is a development from 1/1/2024 down through 12/31/2024. Line items 1 through 4 are expected natural occurrences that we expect each year. So we can see that the interest is going to both grow your liabilities and your assets. We expect both of those to grow at the same 7% assumption. We expect that participants are going to grow a benefit with that normal cost. We expect contributions to come into the plan and benefit payments to be paid out of the plan. So just through those expected occurrences, we expected the unfunded accrued liability to decrease from 10.174 million to 9.887 million. And that would be, if all of our assumptions came true, you would achieve a 7% investment return. The contributions are listed and the benefit payments are listed. Number 6 are things that happened that we weren't expecting. First is the change in the actuarial assumption. So this is increasing that blended discount rate from the 6.05% that was used last year to the 6.28% that is used this year. So that decreased our liabilities because we're using a higher interest rate. We're trying to get back to 7%. So we're expecting anywhere from a $1.5 to $1.7 million reduction in liabilities as we continue down that path. The second item is the actuarial gains and losses that occurred, and this is a liability loss of $624,000 that represents additional compensation increases above what we were anticipating in our salary assumption. And then on the value of assets, the asset outperformance was $588,000 compared to our expectations. So the net is that you improve your funded status a little bit more than we were expecting. And your unfunded liability at the end of the day is 9.165 million. So we'll keep going. We're going to skip past page 9 and go to page 10. I like page 10 and 11. It provides that historical context for where has the plan been and why. We can see here on page 10 a review, a 10-year history of our actuarially determined employer contribution. And we can see from 2015 to 2019 a continual decline in that actuarially recommended contribution. And that aligns well with the investment performance, which is summarized in the bottom. You can see some outperformance during that period until you get to the 2018 plan year where there was a negative 5% investment return. So the following year, 2019, we see a pop up in that actuarially recommended contribution to start funding that deficit that was created from the investment performance. And then 2020, 21, 22, again, really positive investment years, phenomenal years, 19.5% investment return in 2019, 2020, and 2021. And we can see that actuarially determined employer contribution dipped down again until you hit 2023's recommended contribution, which is a huge spike, reflecting the negative 13.3% investment return. So we're seeing these kind of same cycles, 3-4 year cycles of 3 good years followed by a market correction, and we see the recommended contribution following suit. If you look on slide,
We're gonna have a bad 2026.
So AJ,
Yeah,
before you move
3 years.
to page 11, I'm looking at our actual employer contributions, right? That third column.
Mhm.
And then I'm back on page 5. There's an estimated tax revenue contribution of 700,000. Is that just an average of the last 5 years? Is that
So 700,000 is our estimate of the
Mhm.
contributions based on
how did you
tax
get to
revenue.
how did you get to the estimate?
So generally it's based on tax revenue, but we coordinate with Darren on expectations.
Okay.
So it's Darren's fault again.
It would align closely with what we would see on the property tax assessment, the auditor's report on what. The
I would
pension
rather
line
Darren
is.
underestimate than
Yes.
overestimate.
I agree.
On page 11, what we can see is that full reconciliation of liabilities and asset developments going back 10 years. So a few items that I'll call out from this page. This will help again, just provide context of where you've been historically compared to where you are today. If we look at the 2015 column all the way to the right, the funded status position was 74.93% funded as of that date. And we can see here as of 1/1/2025, you're now 71.51%. So a similar place funded status wise that you were from 2025 all the way back to 2015. And we can see the funded status improve again as those investment performance outperform expectations. You went from 74.93 in 2015 up to 82.52. And then with that underperforming year, back down to 73. And you've came up all the way to 2021, where you hit 93% funded and fell to 66.95% in 2022. So we're seeing these kind of natural ebbs and flows with the investment returns. One other item that we can call out is that the service cost component of the liabilities is elevated compared to where it's been historically. So back in 2015, the normal cost, the cost of those benefits providing to participants was 241,817, and now it's double that, more than double that at 525,000. So again, that's tied to compensation. So as compensation increases, and we expect compensation to increase, we'll see that service cost component also increase. And just to note, a lot of times in the governmental plans where tax revenue is improving at a 2% or 2.5% rate, and compensation growth is growing at a 4 to 4.5% rate, there's a disconnect, and that compensation is going to eat up more and more of that tax revenue budget that'll need to be rectified in the analysis. So we're seeing that play out here because we can see the contributions, we can see the service costs, and there's a disconnect there. So it's
feel like-
eating up more of that cost.
I feel like we ask this every year, maybe I'm just imagining it, but what would that percentage of funded fiduciary net position percentage total pension liability need to be to consider like freezing a pension?
So in terms of, you can make the decision to freeze the pension at any point, right? And move to a different form of compensation. You want to terminate the plan, that would be paying out all benefits and kind of getting out of the pension space altogether. You would need to be closer to 130% funded on that basis. And currently you're 71% funded.
Yep.
Because you'd have to pay out lump sums, which are generally valued more at that 5% discount rate, or purchase annuities, which is a more expensive option.
Yep.
So to fully terminate, you would be north of 130% or so.
So just double where we're at right now.
Right.
No worries.
But if you were to maintain at about, a healthy plan would be somewhere in the 90 to 110% funded status range. So that when you get to 110%, the market corrects, you kind of bounce down to the 90s and find yourself kind of in that 90 to 110% range, as opposed to the 60 to 80% range. Because as we'll see in a couple of slides, the interest on that deficit is really eating away at your ability to fund up and improve the funded status of the plan. So we'll skip ahead then to page 16, which will be my final page. And so this is kind of the health of the plan and the trajectory moving forward. Kind of again, getting to that question. This is going to be yet again a third funded status measure. All right, so this is a funded status using 7%, but it's using that actuarial gymnastics approach. So we're still pulling in costs that are accrued later in a participant's career, but funding them on a level approach. On this basis, you're 77% funded. And so that basis would be more consistent with your historical funded statuses on page 11, because before 2021, we've always used 7%. So that's kind of where you would rank using a 7% assumption. Down below, using the expected contributions that are coming into the plan of 947,000, the benefits that participants are accruing, again on that 7% basis, 501,000, you're contributing $445,000 excess over the participant accruals to help fund the deficit. But the deficit, which is currently at 6.876 million from above, the 7% growth on that deficit uses up all of those excess assets. So you're essentially treading water at this contribution level, and you're relying on investment returns to continue to push the funded status forward. And we expect 7%. So in order to move that funded status up, you need to perform above 7%. Now, year to date, again, in 2025, markets have been favorable. I won't steal all the thunder, but year to date, you're probably close to 12% return. So that's about a 5% outperformance. Who knows where the assets will end at the end of the year, but that's going to further buoy those returns, get that funded status up an additional 5%.
But in general, a interest rate environment where we're decreasing is not good for the pension, correct? Or not necessarily?
Not necessarily. I think it has a couple of components. In your investment portfolio, you've got fixed income assets. So as interest rates decline, those fixed income assets have a gain in this year. So you're going to have a little bit outperformance, but that means that your interest on those in the future is going to be deteriorated. So it's going to be harder for you to achieve 7% if your bond portfolio is only getting you 4% versus 4.5 or 5.
But then the expected spread of equities to a lower interest rate environment would also be projected to be lower, essentially.
Right. And I think that the market is a little slushy, right? Where are we going with equities? We've had 3 really great years. I think that what I've seen is it's really been fueled by AI development and the growth. The GDP growth numbers have been great, really fueled again by AI development. Some people think that maybe that's a bubble. I think that that's probably not as transitory. I think there's still going to be a lot of money being pushed into that space to get industry moving forward and adopting those AI tools and techniques. But there is there is a little bit of slush in the market, and I'm not super bearish on it, but I think 7% is still a long-term expectation for the asset allocation that you have. We do see continued push down on capital market assumptions. 2 years ago, right after the negative return, we saw our capital market assumptions supporting 7.5%, 8% return numbers, and now we're back to the 7%, and we've kind of stayed at that 7% expectation over that period. So I think my closing message would be you're treading water. The investment return year to date, again, is going to help fuel improvement when I'm here next, September, maybe a little bit earlier. We'd love to see this plan get back up north of 90% and see that this line item here on page 16 get closer to about a 1% improvement level, so that you can start to really see the tangible improvements for that contribution exceeding those benefit accruals. So again, I think the markets will keep pushing this plan forward for the time being. Any questions?
Anything? We appreciate it, AJ.
Excellent.
Thank you very much. All right. Jonathan, you got big shoes to fill. He said you got to get 25% return year over year.
Probably not gonna happen, but we can try.
Not with that attitude.
Yeah, I know.
Okay, you're pulling it up, Jennifer. Alrighty. All right, so for today, we have your standard reporting. We have your third quarter report as well as a rebalancing recommendation. As AJ mentioned, markets have been hot. Want to always kind of take the wins when we can get them, kind of trim from equities and such, but more on that later. As usual, we'll go ahead and skip the market environment for sake of time, because I know you guys are all familiar with what's been going on. We'll go ahead to, it's exhibit 1, sorry, of the report. Page 1 of the report is your manager status page.
Under,
Exhibit 1, sorry, it's,
that's fine.
yeah,
Okay, we're
giving
good.
way, pretty much
Yeah.
halfway through the book now.
That's good.
With that one,
Okay,
just
no,
skip.
you're good. You're good.
This is all your manager lineup. All managers are currently in compliance, so no issues here. Go ahead and flip to page 3. This is what we call your performance summary. It's just kind of a good snapshot of, hey, one page, how did the plan do for the quarter? How has it done over time? Cash flows, asset allocation, that kind of gives you everything, all that in a nutshell. Next on page 4, I'll spend a moment here.
Teed him up. He said, you
Yeah,
probably.
right
about
around 12% or so
Yeah.
on the dot.
Yeah.
So page 4, this is your market value page, shows you all your managers, all your different composites, what asset class they correspond to, what your beginning market value was for the quarter for all those, net cash flows in and out for all those line items, ending market value as of September 30th. And then to the right of that, on the right side of the page, you have percent of portfolio. So that's the current weighting for that, the composites and the underlying investments compared to the total value of the fund. To the right of that is your target allocation. So that's kind of the target the weighting you're trying to maintain for those assets. So end of the quarter with $24,524,942. Overall, mostly in balance, but markets have been hot. So equities have run up quite a bit. On top of that, you do have quite a bit of cash flow out of that print, especially the principal core fixed income investment there. So that has ate away at that weighting for your fixed income allocation. So underweight fixed income, overweight US equities, non-US equities, in balance for real estate and private equity for the most part. So later on, like I said, we will have a recommendation to trim from equities and contribute back to fixed income. Page 6 just shows you how your plan looks like graphically compared to other public defined benefit plans. So one, for instance, would mean that you have the highest weighting in that asset class for your universe. So public defined benefit plans, 100 would be the lowest. So, not going to spend any time here, but just for sake of explaining the page there. Page 7 is a historical asset allocation, only goes back 4 years. But shows you kind of how the plan has changed over time from an asset allocation perspective. Page 8, I will spend a moment on. This shows you the market value over time, specifically over the past 10 years on the top part of the page. Bottom part of the page shows summary of cash flows. So it just shows you different time frames. Where do you start at? What were your cash flows in and out for that time frame for the total plan? What was your net investment change and what was the ending market value? So for the quarter, started out with just under $23.9 million, had negative cash flow out of roughly $545,000, positive net investment change of 1.2 million, and that's how we ended up at that value of just over 24.5 million. And as you go back in time, you see that same information going back to 10 years. Negative cash flow out for the most part because it's a mature plan. You have a lot of benefits going out, but as AJ mentioned, really what's kept us afloat is the income and appreciation of the assets in the plan. Page 9. I'll just focus on the top line item here because everything else is for the most part repeated. So for the total fund for the quarter, we had a return of 5.2%, so just slightly ahead of the benchmark. Year to date, a return of 12%, as AJ mentioned, just in line with the benchmark. Rankings, almost in the top third of your universe, so that's kind of where you want to be, at least above the median. 1 year, you're ahead, above the median, and then past that, it's a little more mixed. For the 3-year time frame, you're a bit below the benchmark, ranked fairly low. 5 years ahead of the benchmark, ranked right around the middle. 7 years, just a little bit behind the benchmark, ranked low. 10 years at the benchmark, ranked in the middle. So like I said, kind of mixed. Since inception, we are below the benchmark and ranked fairly low, though. But that goes back to 2003, so it's quite a long time frame. As I mentioned, we'll skip ahead. Page 10 just shows you what I just went over graphically. Page 11 is your calendar year returns going back about 10 years. And then page 12 is where we'll peek under the hood here and look at the different composites and underlying investments. So already hit the total fund. Fixed income composite has done well, outperforming for most time frames, just behind year to date slightly since inception, matching the benchmark. Rankings recently kind of mid to low. Long term, though, mostly above the median. Principal core fixed income has done well over time, outperformed for most time frames, matching the benchmark for 7 years. Rankings good recently, going out to 1 year. Past that, more mixed, below the median at some points, at the median or above, depending on which time frame you look at. So kind of mixed going back in time for the rankings. Principal core plus bond, not doing as well as core. Outperforming more recently, underperforming for 1 and 3 years. Long-term outperforming, but rankings in that core plus universe pretty low, mostly almost in the bottom decile in a lot of cases. And thankfully, though, we did move half. We kind of cut that in half at the last meeting and split that core plus mandate between Principal Core Plus and Baird Core Plus, which you'll see as the next item here is Baird Core Plus. Only have 1 month of data there. That was their first full month of performance was in September. Matched the benchmark, no complaints. We're going to give them some time, of course, and see how they do. But overall, they've been a good manager for a lot of the other clients that I work on, so wouldn't expect any different here. Principal high yield. This is your high yield allocation. And this was the strategy that they actually forced a transition to at Principal because they stopped and liquidated the high income strategy. So it went from high income to high yield, which is kind of funny that they, how they named those. But that's only been funded since March. That was their first month of full month of performance. So far, underwhelming. But this is part of that Principal allocation. And we decided to split the Core Plus mandate and shift that out to get more away from Principal. So for now, I'd say you're kind of stuck with this, at least for the moment, till that benefit index ticks down a little more. Aristotle Pacific is your floating rate bank loan manager. They had a really good quarter, and that's actually helped their long-term numbers now outperforming for most timeframes, ranked pretty high in their universe for all timeframes as well. I'd attribute this a lot to the fact they did not have any first brand exposure. The one that I'm sure you all saw that in the news when that car manufacturer was lying about their receivables and probably some other things. But that helped them relative to the benchmark because some other players in that space did have exposure to that deal, first brands. Page 13, and this is not as rosy of a story, but this is, I kind of keep hitting it. It's, it's like beating a dead horse. U.S. equity allocation has been underperforming for all time frames here. Improving more recently from a rankings perspective above the median for the quarter and year to date. Attribute a lot of that underperformance to over allocation toward mid cap and small cap stocks. Going back 10 years, just they've been unable to outperform large caps, and that's weighed down on them. Long term expectation is that small caps, mid caps should outperform large caps. I know we had this discussion last time, but
I mean, I hope you're right, but
I do too.
but I'm not so sure.
Yeah, it did improve recently though, but
Yeah.
I will say that rally in small caps was very junky. A lot of unprofitable companies
Uh-huh.
really leading the way.
There's not a lot in there.
Yeah. And it's like nuclear companies,
Mhm.
Bitcoin related cryptocurrency company, things like that. So, that seems to have evened out a little bit. But our small cap exposure is in the S&P 600, which does have a higher quality bias. So
Mhm.
long term, that should, I think, be beneficial. But yeah, underperformed for the quarter. Everything's indexed here, so all these managers are doing their job. They're matching the index. Mid cap was the main laggard for the quarter. Small cap exposure was actually your highest returning U.S. equity allocation for the quarter, but long term, it's another story. So we've done some work to trim back those overexposures to mid and small cap. We'll see if the story turns around, which many expect it will with rates coming down, but it's a, you know, that's a question that we'll have to answer at a later date to see if, you know, going forward, are small caps and mid caps where you want to have this kind of bet in. Next, on page 14, we have your non-US equity exposure. That has improved recently because you do have an overweight to emerging markets. So emerging markets was the best performer for the quarter, at least out of our lineup, which is just a broad non-US equity index and then a small cap non-US equity index. But long term, that has been a detractor for the non-US equity allocation. Overall, these managers, like I said, with US equities, they are trying to replicate the index essentially, but in the non-US space, it's a little trickier than that. More tracking error involved, higher costs usually, and in some cases, there are some companies you can't even buy that are in the indexes, which, you know, you'd think that wouldn't be the case these days, but it is. So overall, they're doing fine. If they are ahead or if they are behind, they're not too far ahead or far behind. So within expectations, I would say the deviations from the benchmark from these managers. Real estate has actually had quite a turnaround after 2 really rough years. It does look like the trough has been made, and they are starting to come back. And most likely, when you do see that happen in the private real estate space, it's typically about a 10-year time frame where you see positive returns. So it looks like they've shot out of the hole. Principal has had a really good quarter, and it's actually made up for their underperformance in the long term. So now, for all time frames, real estate is positive. Private equity, we just have one manager as well, Partners Group. We only have them through August, and the benchmark has always lagged by a quarter or so. So we don't have that either. But long term, they've done well. Year to date, 1 year, they are a little bit behind. Not unexpected. It's an open-ended private equity fund. As closed-end funds did poorly, 2022, 2023, they did well. Now it looks like the closed-end funds are coming back and they're not keeping up as much. So not unexpected there. And then you have your cash composite, which is just invested money market fund, and that's done its work there. And we don't really have much exposure or much of an allocation to cash. After that, we just have a bunch of calendar year returns for all these managers and composites. Then we have some risk statistics, but we'll skip those. Page 20. Always like to look at the fund from a risk return perspective, and this is just over a 5-year time frame. The fund is the blue square on the page. Your benchmark is the black diamond. The crosshairs is the median of the universe, so the public defined benefit plan universe. All the little dots all over the page there are other public defined benefit plans. So you see the fund is outperforming its benchmark, but not outperforming the median of the universe. But it does have less volatility as measured by standard deviation compared to the benchmark and the median of the universe. So overall, not in a bad spot. Would like to see it get bumped up a little bit into the top left quadrant there, and we're getting close. But it is a tough task, as I've seen across a lot of our plans. Page 21, also like to look at fees here, and we do have some good news to report here with that changed by having that Principal Core Plus allocation and giving that to Baird Core Plus. So you see, you know, we have the fee schedule for all the investments. We take the values as of the date of the report, so as of 9/30/2025, estimate what that annual expense would be based on that for each manager, equate that to an expense ratio, and put that up against what the industry median expense is for all these mandates or similar mandates would be. Total it up on the bottom, so that middle blue line on the page there, we estimate you're paying all your investment managers $85,646 annually. That equates to 35 basis points, and that is actually right in line with what the industry median is. Last quarter, you were above that, and that was because of that higher allocation to Principal Core Plus, because that fee is just astronomical. And we'll start to shift more away from there as your cushion builds back up with your benefit index. Any questions on the quarterly report? All right, cool. Exhibit 2, which is just the second to last page in the report, is a rebalancing recommendation. As I mentioned earlier, markets have been really, really hot, and you know we don't want to get too far over our skis. Even though I'm sure there are a lot of nice stories out there saying the AI story is never going to end, and we'll have 5% GDP growth every quarter for perpetuity. So recommending we sell $350,000 of the Vanguard S&P 500 Index Fund, 60,000 of the iShares Core S&P Small Cap Fund, 210,000 of the Vanguard Total International Fund, 90,000 of the Vanguard Emerging Markets Fund, 65,000 of the Vanguard International Small Cap Fund, and contribute 675,000 to Principal Core Fixed Income and 100,000 to Principal Core Plus. And this is just primarily because Principal Core is where you have those distributions come out of for benefit payments. So that gets drawn down quite a bit over the course of the quarter. And with equity markets rallying on top of that, that kind of makes that their underweighting look even more overexposed, I guess I would say, compared to if markets were a little more even.
Question for you.
Mhm.
Mike and I looked at this. Your total plan is 24.5. And when you do the principal assets, regions assets, other assets, it's 23.
Oh,
Two.
yeah. Sorry, I noticed this after we sent it out.
Okay, is it
Yeah.
just an error?
It's because we added in Baird Core Plus and forgot to add it in.
Oh, okay.
Yeah, but it's not affecting the
No,
everything above
I
it.
was just
Yeah.
wondering if there was a method of the madness, or was
No,
it
I saw that yesterday and I was like, you know what? They're gonna catch this. But I didn't want to send something else out again or reprint
fine.
everything.
That's
So,
Okay,
But I double checked after I fixed it and it matches now.
good. Okay, that's all I wanted to know. And our cushion, we're good?
Yeah, so cushion is on the next page.
Yeah.
Yeah, I guess you're already there. So cushion there's two numbers here. The green one is what they provide us as of 10/31.
Mhm.
The top one is actually as of November 1st, because that's the day they take out the benefits from the principal core fund. So the cushion actually decreased from 10/31 to 11/1. So I wanted to include that
Okay.
just so we had I consider a more realistic measure, because they took it out. So
Okay.
not bad. We're still over 500,000,
Fine.
but definitely want to bump that back up.
And that's what we're doing here.
Hmm.
Okay. All right, good. All right, any questions? So the motion is to do the recommended changes that Jonathan has made on what we,
Per the balancing,
for the what?
per the rebalancing spreadsheet.
For the,
Mhm.
thank you. That was a big word for me. For the rebalancing spreadsheet. That's the motion. We have a second.
Second.
All right. Any discussion, any questions? Anything? Anybody? All right. All in favor?
Aye.
Aye. Any opposed? Any abstentions? Awesome.
All
Okay.
right. Thank you. We'll work with Jennifer and Darren to get
Yeah.
it executed.
Right. Darren, make sure you do it before January, okay? Sorry.
Yeah.
Awesome. Thank you. All right, do we want to discuss the principal contract?
Go ahead.
I don't know if is there an update?
I don't have an update. I mean, the update is that we met with the lawyers and there isn't a we can't get out of the contract
Correct.
without buying the annuities.
Yes.
So they wanted to do just a little more research. We can choose to approach principal to see what it would cost. But there's no legal basis to say that because this is an old contract and a method that is generally not used in pensions currently to be able to get out.
Yeah.
So
That we had a contract attorney, not an ERISA attorney, to do that. And unfortunately, as Jennifer said,
even though it's 50+ years old, we're locked. At least in their feeling. They also said, and to reiterate what Jennifer and I were talking about, that they can't believe that Principal doesn't have this over 100% funded of their portion. So it wouldn't, they think it's not gonna, it would not cost us anything to get out of the contract and annuitize it. What does that look like? What does that mean? We have no idea. And that's what they were looking into. So,
So no decision points from the pension
No.
board at this point. If we get more information to bring back to you as a decision point, then we
Right.
will.
correct. So, questions? Anything? Good. All right. Anything else? Any new business or old business we need to discuss?
I
Austin?
don't have anything.
Okay. Motion to adjourn? So,
Second.
perfect. Meeting adjourned.